So folks, welcome back to our part two of our discussion of income taxes and specifically dependents in this chapter. A dependent is either a qualifying child or a qualifying relative, and you prefer the qualifying child for a couple of reasons, especially the credits, but it can be a qualifying relative still works in many cases. So usually what you want to do is consider if they're a qualifying child. If they're a qualifying child, you're done. That's the best scenario. If they're not, if they don't fit that, then you fall to the qualifying relative to see if that works. All right. So the taxpayer tests, general tests. First of all, you have to understand only any person can only be claimed by one other person as a dependent. There's no splitting, there's no part way, half and half. You are a dependent of one individual or another. You could be a dependent of a married filing joint couple, but you can't, other than that, you have to be a dependent of a single person in terms of tax filing. You cannot be a dependent. If you qualify as a dependent for more than one, there has to be a decision. There has to be some way to determine that what we really refer to as a tiebreaker test, or there has to be a form filed determining who it is that gets to have that individual as a dependent. So you can't be a dependent and file a joint return unless you file that return only to claim a refund. Meaning you didn't need to because your income isn't high enough. You don't have to pay any tax liability. If you file it just to get the money back that you had withheld from on your W-2 as a dependent, as a joint return. So usually, if this is the case, you're dependent, you're jointly, it's the idea that you're married and you move back in with mom and dad because the income is really low and you don't have the ability to support yourself, that sort of thing. Then you could still file a joint return and be a dependent of your parents. So that's what kind of situation you're dealing with there. And then you have to be the citizen test, which is usually pretty easily determined, but we have to put this in because of the U.S. citizenship and so forth. So to be a qualifying child, remember that's the first thing we want to look at is, are you a qualified child? You have to be related in a way that is listed in the tax law. Okay, so it's not for everybody. Have to be a child descendant of a child, so grandchildren count, stepchild. We've now expanded to eligible foster children, and then siblings, half siblings, that sort of thing can be a qualifying child. They have to fit the age, so this is where it becomes a little harder. The age test, you're either under 19 or you're under 24 and a full-time student. And although we extend this up if you're fully disabled, permanently disabled. And the age test could be determined, you have to be younger than the person claiming you as a dependent. Residency is living with the taxpayer, and they can be away for school, so you can have a dependent that is away at college, as long as that they fit the others, and that is they still consider their home address and stuff like that with their parents, that sort of thing. Support. Now, notice that the support test is that the person who is the dependent cannot provide more than half of her support. So the child can't be supporting themselves. Okay, and then of course the issue of what determines support, you can see the list in your textbook. Okay, to determine if they do that. Now, it's usually pretty obvious. Most kids are not going to be providing their own support, and so you're good to go. But occasionally, especially as a child gets a little older, and they may be doing some of that. It's depending on the situation. All right, and then if you fit for more than one, you fit these tests, then we have a tiebreaker. Okay, and usually that's to the person that has the highest AGI or who has custody when there is, and parents always trump non-parents when tiebreakers are on the line for this qualifying child. So now, if you don't fit this qualifying child, you could be you could have someone living with you that you're providing for that is a qualifying relative. So if you're a qualifying child, then that's you're already taken care of. But the relationship is broader here. You notice that we're now talking about fathers and mothers. We're talking about in-laws, sort of thing. So the list of relatives gets broader for qualifying relative. But even people who are not related, as long as they live with you the entire year, they could be a qualifying relative. That sounds a little weird, but that is how the law reads. They're still considered a qualifying relative if they're a member of your household for the entire year. So somebody wanders in off the street, you give them a place to live for the whole year, they could be a qualifying relative and a dependent. However, qualifying relatives are subject to the gross income test. Now notice there was no gross income test for qualifying child. That's why it's the preferred standpoint. So a qualifying relative cannot have gross income greater than $4,200. So that amount is adjusted for inflation, but it goes up each year, but they can't have very much income. And then the support test is different. Instead of saying, did the child or relative provide support, the question is, can you prove that you provided as the parent or as the person claiming this dependent support? So it's a little different test, a little harder test. You have to be able to show that you actually provided more than 50% of the support. Okay. Now there's things where multiple people provide support, like mom is in a nursing home and multiple children pay for her support. As long as they're over 10%, and it has to be over, not equal to, but over 10%, they can agree amongst themselves to be who's going to receive the dependent. And there's Form 2120 to help determine that, and the ones that give up the dependency so that at the end of the day, only one person. So what happens with the IRS, when all of the tax returns go on the computer, everybody's Social Security number is matched up. So if someone is on a return as a dependent someplace and it shows up again somewhere else, the second instance, and maybe even both of the instances, are going to be disqualified, and a letter is going to go to both of them saying, hey, we got a problem here because two people are claiming independent, and they'll basically disallow it in both places. If one files well before the other, the first one will probably get the dependent, and the other one will be told no, their return will get rejected. Because remember, over 80% of tax returns are filed electronically. That makes the matching relatively straightforward to find when two people have claimed the same dependent. So, we talked about the standard, the idea of filing status. Your standard deduction is determined by your filing status. Notice qualifying widower is the same as married filing jointly, as we mentioned earlier. It's really not a separate status. It just has some different definitions. Okay? There's this increase in the standard deduction that it's easy to forget when calculating the standard deduction for an individual. That it only applies to additional standard deduction, nothing to do with exemptions or that sort, and it is only for the person filing. So you have to be over 65 or blind, and then you get an increase in your standard deduction for that situation. Okay. If you're single, the additional is $1,650. Married, $1,300. Notice these are the same, and these two are the same. Qualifying widowers, because it's really married filing jointly is the same. The other issue with standard deduction is if you can be claimed as a dependent. Remember, even though you may be claimed as a dependent, you may be a qualifying child, qualifying relative of someone else, you're on their return as a dependent, you still may have to file a tax return. And your standard deduction is limited, okay, to either $1,100 in 2019 or your earned income. You have to have a job, get wages, that sort of thing, plus $350, okay, up to the regular amount for a single filer. So if you made $100,000, you don't get a standard deduction of your earned income plus $350. The maximum that you could have as your standard deduction, if you're a dependent of someone else, is this single amount, $12,200. So this is another time where it's important to know who is the dependent. Now notice that this technically says you can be claimed. Doesn't say you were claimed, just can be claimed. So you could have the IRS challenge that even though someone doesn't claim it. Remember, more than one person could claim a dependent. And if that's the case, even if somebody didn't claim you, you still could be limited to the $1,100. Now it's really hard for the IRS to know that and enforce that idea, but that is technically the rule. Okay? Talked about how tax liability is computed in Chapter 1, either using a tax table if your taxable income is under $100,000, or a tax rate schedule. Okay? We said that most people get money withheld by your employer, but you can also make estimated payments if the withholding is not enough, or you have business income where you are not an employee. When we start talking about tax credits offset your liability. They are not deductions. It's important that we understand the difference between a deduction, which reduces your either AGI or your taxable income, but doesn't affect, your tax liability per se, and a tax credit, which offsets your tax liability. So, for instance, if you had $10,000 of income and you have a tax deduction of $1,000, your taxable income might be $9,000. Your liability, would be then calculated on that $9,000. A tax credit would actually reduce the amount of tax you received. It would not be deducted to your taxable income. It would be simply reduce the amount of your liability. And there are two types, non-refundable and refundable. Non-refundable means it can reduce your liability down to zero, but you can't get a refund back. And refundable, just like it says, means you can get money. It can be negative tax liability, which means the government owes you money. So a non-refundable tax credit, if you have a liability of $400 and a tax credit of $500, but it's non-refundable, you're only going to get a benefit of the $400. It's going to reduce your liability down to zero, and you're never going to see that $100. If it's refundable, then if it would reduce your tax liability from $400 down to zero, and then you get the $100 back. Some tax credits are even both. They're split into two, and we'll talk about that in another chapter, and you'll see how that plays out a little bit. Okay? If you pay too much, you get a refund. That's what people talk about in April, getting their refund, spending it, that sort of thing. Okay? You may owe the tax liability if you did not pay enough in. Remember, the tax return is basically a settling up of how much you owe versus how much you paid in. If you don't pay, you may end up paying interest and penalties. Here's the rates that you pay on that. It's not exorbitant rates, but not cheap either. Okay, so if you don't pay your tax when it's due, they will start charging interest based on the number of days or months that you have not paid. Penalties, a couple of them: failure to file a tax return. Your tax return is due individually, your 1040 on April 15th, 3.5 months after your end of year. If you don't file that, you then have a failure to file a tax return. All right, you can avoid that by filing a 6 months extension and avoid that. However, the extension is not an extension to pay. So even if you extend your return, if you end up having to pay, you still could have a failure to pay your tax penalty. So you may avoid this penalty, which is 5% per month. It's pretty expensive. Much better than 0.5%. That's about 6% a year. Okay, so you're better, to make sure you get it filed, even if you can't pay it, because your failure to pay is much lower. And then, of course, there would be interest on top of that, and that sort of thing. Okay, so you've got two penalties, and they're separate. Not filing is a bad idea, and missing the deadline for the extension is also a bad idea. Okay. They could both apply if you don't file and don't pay. Okay. Also, you have to pay in advance. Your failure to pay estimated taxes, you have to pay either what you owe, 90% of what you owe now, or 100% of last year's. Okay. Unless your AGI is over 150%, then you have to it's the current year's liability, can't use last year's. If you really screw up and you just admit something, you could end up with a negligence penalty. That could be as much as 20% of the tax due if you're off by 25%. And then if the IRS thinks you just willfully, you just filed a return you knew was wrong, didn't claim income that you knew you had, it wasn't a mistake, it was literally you wanted to defraud the government, you could have a penalty up to 75%. Now, of course, that's on top of your failure to file, failure to pay, all the other ones. And then if you claim a refund that you're not entitled to, because all of these are based on what you owe, what if you got money that you weren't supposed to? Then there's a penalty for that as well. So you need, again, these are not to scare you into feeling like you're going to get picked up, scooped up off the street by the FBI, but to understand that you need to do your best job you can. As long as you put your best effort into it, for the most part, these penalties will not be substantial, and just make sure that you report income the best way you can.